Hey everybody, it's me, Gregory Manarino. Welcome, seriously, to my post-market wrap-up on this Wednesday, January 9th, 2019. If you recall my post-market wrap-up from yesterday, I said that the stock market gyrations were a ride into the pit of hell. Well, today was even worse. We have now hit the core of hell today. We're talking about triple-digit moves up and down pretty much every 15 minutes. This was outrageous. Somebody wrote earlier today, it's like convulsions of this market when someone's about to die. Well, maybe that is true, but let's talk about a few other things here. I guess we'll start off with, instead of the stock market, which you already know, all over the place. We did finish positive, about 90 points below the open. We had a triple-digit gain here at the open, as high as 200 points to the good with regard to the Dow Jones Industrial Average. We finished higher, about 90 points. That says something in light of what happened today. But let's back up. Let's talk about the thrashing that the dollar got today. We're talking about a dollar that got decimated. Why? The Fed minutes. Let's talk about the Fed minutes real quick. So it seems that the Federal Reserve is downgrading their outlook for GDP moving forward. So I guess our economy is not as strong as we're being led to believe that it is. Okay, that's one aspect of the Fed minutes. The other aspect of the Fed minutes is, well, they've come to the conclusion that the market, despite how strong our economy is, like I just said, they're downgrading it with regard to GDP moving forward. We're going to keep rates more or less where they are. And when the market got the minutes, when they first came out, we went zoom right up to the intraday high. And then within 15 minutes after that, of course, we got a reversal, just like it's did all day long. It's completely outrageous. Now, going back to the narrative of our strong economy, we found out JCPenney is closing more stores. Very sad to see this happening. Sears and now JCPenney. And if that isn't enough of a warning with regard to our strong economy, well, how about this one? Lennar, one of the biggest home builders in the United States, they said today that they cannot even give forward guidance. This is a publicly traded company for 2019 because of weakness in the housing market. Ironically, their stock actually went up today in this twisted freaking market that you cannot believe. Let's talk about a few other things that had they not happened. How about one? If it didn't happen today, this market would have been markedly lower. Crude oil put on a gain of over 5%. What did that do? Energy sector, boom, higher. Financials, higher as well. Tech got bid up as well because of Apple. But crude oil was a major player today in this twisted market. It's unbelievable. Let's talk about something else kind of twisted. And this really gets under my skin. And I'd love to hear your take on this. So if you're watching the collective COD today, the narrative is pretty straightforward, that the U.S. consumer is strong. And they're gauging the U.S. consumer strength by the fact that we just hit another record high with regard to consumer debt. So what they're saying is, the more in debt somebody becomes, the stronger, I guess, the consumer is, that person is. Let's put another perspective on that. So if someone has a positive net worth and has zero debt, they're a weak consumer. I'm going to use myself as an example here. Most of you know I just bought a BMW. I paid cash for this, okay? I didn't borrow a freaking dime. So I guess that makes me a weak consumer? I don't know. I don't think I'm a weak consumer. No. But again, that's their perspective. It's ridiculous. It's the truth. You can't make this stuff up if you even tried. The more indebted an individual gets, I guess, the stronger they are. The more indebted our country becomes, we're now, 22, 23 trillion in debt? I mean, that's, not including the derivatives and everything connected to it. Let's just use their number. National debt. Oh, that means we're a strong country because we're the most indebted in the world. Oh, that makes a lot of sense to me, too. Now, before I let you all go here, I want you to ponder all the stuff I just said. I also want you to ponder this. About a week and a half ago, the U.S. 10-year yield hit 2.55 in a very unstable bond market. We were on the cusp of a full-on inversion. I think I went nuts. The spread between the federal funds rate, the overnight rate, and the 10-year yield was fractional. And we were really there. Well, since that time, the U.S. 10-year yield has managed to come up 2.72 last time I checked. Now, what's driving that? Very simple. We've had this this rally in the market in a downtrend. That's what we have. It's a rally in a downtrend. This market topped out in October and remains in a downtrend. For all you chartists out here, you know exactly what I'm saying to be 100% true. So this rally in a downtrend has caused some cash to make its way back over to the stock market here. This will change. I do not believe that the trend has changed in this market. Now, I know this is getting kind of long-winded, but let's think about these things here. So we got Fed minutes, very, very dovish, melted the dollar, all right? Still, stocks only finished 90 points to the good with regard to the Dow Jones Industrial Average off of this, with crude oil being bid up 5%. Then all the stories today getting floated out here with regard to a possible deal with China. There's little tidbits are coming out, little flecks of dog shit that they're flowing out. That's what they are, little flecks of dog shit that they're flicking at us to try to make us, it's a deal. Still, the Dow Jones Industrial Average finishes up 90 points. Are you kidding me? Are you kidding me? All right. So anyway, I know I covered a lot of things in this video. I want to hear your take on it. I really do. This is what will change my mind with regard to this market. Because there's a lot of people out here. We've seen the bottom. We've seen the bottom. We've seen it. We witnessed it already. Really? How did that come about? Let's see. President sends out his guy to the 6 of the biggest banks on Wall Street to prop up the market. He gives a buy recommendation. All of a sudden, stocks bounce. It's fake. It's just freaking fake. It's engineered. It's going to play out, I think, still in a very negative way. And I do believe still that the lows that we witnessed prior to that whole escapade are going to be revisited in the not too distant future. Now, what will change my freaking mind here? If we get a breakout to the upside of the downtrend that we have been in for the past 3 months. So all you gleeful individuals out here, good. Let us know what you're buying, because all we're in right now is a rally in a downtrend. You're going to get your ass handed to you, pardon my French, if you get caught on the wrong side here. And with all the attempts to prop up this market today alone, with the Fed, with crude oil, with all the flecks of dog shit stories being thrown at us, and all we gain is 90 points in the Dow, whoopee freaking do. What do you think of that? Anyway, look, I love all of you people, and just, I just know. With that said, I'll see you all in the morning. It's going to be more fun and games, and hopefully no flecks of things are going to be thrown at us anymore, although we all know that they will. Probably larger ones. Let's see how that turns out. See you in the morning.